Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. Very pleased to welcome back to Forward Guidance Citrini, a stock picker and trader who's been on this program 2 times before, and over the past year has quite an impressive track record. So when Citrini first came on June 2nd of 2023, that was when he filmed it. It aired later on in June. He had just set up his AI basket, investing in artificial intelligence. And that basket, as we stand here today on June 15th, over a year later, is up somewhere around 60 to 70%. And the entire Citrini index, or Citrindex, from May 30th to 2023 to June 2nd, 2024, is up 100%. So congratulations to Citrini. Welcome. Congrats on the great performance.
Thanks a lot, Jack. I appreciate it.
Let's dig into this performance. So some of that performance has come from the AI beneficiaries, Nvidia, SMCI, that kind of stuff. Some of it came from GLP-1s or Ozempic type investments, which we've not discussed really on either podcast, but you did discuss on the Odd Lots podcast last year, which is excellent. Some of them came from fiscal beneficiaries, which we will be talking about today, and particularly how it comes to the upcoming election. And a lot was from interest rates, interestingly. But Citrini, I just want to say, when it comes to the overall market right now, how are you feeling? You have been an indefatigable bull, which has worked out quite well. But you wrote on Twitter recently, actually last night, you wrote that the vibes are starting to shift, I think. What do you mean by that?
The thing about the environment right now is we've kind of hit this point where we're going to find out, right? We've gone back and forth. Is it going to be a soft landing? Is it going to be a reacceleration of inflation? Is it going to be a recession? If anything, that constant wall of worry has driven returns, right? And now we're in a situation where I think over the next 6 to 12 months, we're going to have our answer, right? Are we going to be able to pull off this soft landing? Or are we going to overshoot to the downside and end up with an economic slowdown? I think the reason why it's tricky now is because, you're starting to get some on earnings calls, they'll say, like Toyota Motor, for example, had some cautionary stuff about auto loans and delinquencies, and, the unemployment rate is ticking up a little bit. The household savings rate isn't. I think when it comes to macro, I try my best to not make decisions when the data is unclear. And right now, is this just a classic summer slowdown? Is it, something where this is kind of the necessary, quote unquote, Goldilocks situation where we get like a little bit of economic weakness, but ultimately that's what's necessary to bring inflation back within a reasonable level? I don't know right now, but what's served me pretty well over the past 3 years is I don't make decisions on macro until it's painfully obvious. For example, in 2022, inflation in October 2021 was going higher, and there was all this debate about, is it base effects? Is it transient, this, that, and the other thing? It wasn't until like the Fed really was, we're going to have to hike rates off the zero lower bound. That's when I said, okay, let me start really getting concerned about inflation. I think the same thing applies here with the recession stuff. When the Fed starts cutting, then, that'll be something where I'm going to spend a lot of time saying, is this going to become something that I have to really be concerned about? But for now, I don't want to get thrown off by a summer slowdown. I don't think there's much to do until November, if we're being honest. It's an election year. So the environment right now, I would say, is not something that I'm too concerned about, but I am starting to get a little bit attentive to the risks. If I want to do my best Jerome Powell impression.
Attentive to the risks. Yeah, that's good. So you don't make trades primarily based on macro. I would say you are an investor who looks at the fundamentals of a theme. You dive very deep into the weeds. I guess compared to analysis you'll see on TV or in some bank sell side reports, you get in the weeds. You're not the most in the weeds person, by your own admission. But and then you construct a basket over it. So right now your baskets are your AI basket, your fiscal beneficiaries basket, your GLP-1 Ozempic basket, let's just call it that, and a handful of other baskets that are smaller. But so it sounds like you are not the most bullish you've ever been, certainly not as bullish as you were a year ago. You're attentive to a macro slowdown, and macro can always be a threat to your core longs, but you're not getting wildly bearish. Is that correct?
Yeah, that would be an accurate way to put it. I think what I'm more focused on right now, rather than macro, would be how these kind of mega trends are progressing, and kind of focusing on narrowing down for their evolution. If you look at something like AI, when ChatGPT first came out, you could look at AI and, everyone did this, right? You look at AI and you say, well, I know what it looks like now, but if I kind of blue sky and say what it's going to look like in 5 years, well, oh my God, maybe this is going to put everyone out of work, the thing is, I think that the best way to have played that was, like I said, basically AI is going to be a thing. And in order for that to happen, you are going to need a data center build out, and you're going to need a lot more GPUs. That was the quote unquote picks and shovels thesis. And that has played out, right? I don't think that there's anyone that denies that that's played out. What you needed there was for hyperscaler CapEx to kind of skyrocket so that they could compete in AI. And that's what happened. And you look at some of the areas where fundamentals got a little too disconnected from reality, like Supermicro, for example. That thesis played out, and then it was time to get out because the theme had progressed. And I think it's just so interesting right now when you're looking at what is really the next phase of this going to look like. I would say we're in like phase 1B right now, where there's obviously still some upside on some of these picks and shovels, so to speak, plays. But we're also getting into the area where, what is this actually going to be used for? I think the Apple's WWDC was, I was blown away. I think that really kind of informs what the next phase is going to look like.
It appears to me that over this AI bull market that, let's say, began with the Nvidia reveal of 2023, that there's the real list of beneficiaries whose earnings have gone up a tremendous amount. There's a handful of names, and I really don't know how many I could come up with other than Nvidia. I mean, maybe MCI. I don't know their earnings, but I mean, Nvidia, they're earning, and this is when people say Nvidia is a bubble. It may be, but people cannot deny, and if they do deny, I think they're wrong. Just the tremendous revenue increase from $7.2 billion in Q1 2024, which really means 2023, to $26 billion of the most recent quarter in Q1 2025, fiscal year 2025. So that's an increase of 3.6 times, or 260%. And the stock is up more than that, but the stock is pricing in that Nvidia can continue to grow. So Nvidia's forward earnings, I'm just going to say it's something like 40 or 50. Interestingly, last year, people were saying Nvidia is trading at 300 times earnings, and it was based on the trailing earnings from the cyclical downturn when we had the slowdown of 2022. And like relative to those forward earnings, Nvidia at the time must have been trading at a PE of 15, which is probably cheaper than the value stocks that they like. I don't know.
Well, I don't want to be too antagonistic, right? Because the first time that I was on, I had a big those YouTube comments definitely kept me in the trade for longer than I would have otherwise been in, because it was you couldn't imagine a better environment to generate kind of eye-popping returns in the clear winners, right? Most of the gains were accrued to Nvidia and Nvidia suppliers and hyperscalers. And when you get into a theme, you have like a fundamental narrative, and then you have a sentiment tailwind, and the first thing you focus on is kind of that fundamental story. But as far as Nvidia goes, I mean, I think that using the term bubble, it's much more like a mania, right? Because you look at railroad stocks in the 1800s, There's a great chart out there from an academic paper of the dividend yield, basically, of these stocks, because most of them were, preferred shares back then. And it basically represents earnings growth, and that went up commensurate with the price of the stock, and so I think there's a difference between a bubble where things just get completely fundamentally disconnected and a mania, and obviously a mania can progress into a bubble. I don't think that we're going to see something where Nvidia's earnings kind of level out and the stock continues to go up, right? So I think that what's the most important thing you can do here in AI looking forward is basically, like I said, when I started, I had 130 securities that I was putting on and saying, this could benefit from AI, and then it progresses and you end up deleting some or adding some and kind of narrowing it down as you learn more about what's going on. And like a good example for the first phase, kind of like the build out, TSMC has had this kind of overhang, or I guess like a litany of overhangs. You have, geopolitics. You have the fact that it's kind of lower margin. You have their diversification and how exposed they are to the automotive cycle. But as everything progresses and as NVIDIA is more successful, the TSMC AGM was a couple weeks ago, and the CEO basically said, given NVIDIA's success, we can probably be charging a little bit more. And
yeah, sounds like it.
Yeah, and the surprising thing was, however you would expect NVIDIA to react to that. No, Jensen came out, I think the next day and said, yeah, no, they should be. And, so I think you kind of look at some of these names that they have AI tails, but they have kind of been depressed a little bit, like by external factors. And you wait for those external factors to kind of get a little better. This is the same thing, the last time I was on, we spoke about Micron and kind of the high bandwidth memory requirements for artificial intelligence. That was kind of the same story, where you had, the memory cycle was not doing great, and you had a big overhang from that. But the second that started to inflect a little higher, you got this huge outsized move because the AI tail was front and center. So I think that you can kind of see that on TSMC, and maybe to be a little bit more controversial, I think that it might be time on Intel. Just saying that, I feel like, oh God, this is gonna risky thing to say, but I look at Intel's pipeline, and one of the big things that has kind of become a central narrative here is the power requirements for AI. And as like a student of past financial manias and popular delusions, you can go back and see sell side research from the year 1999, during kind of the personal computing revolution. And what you see there is they were saying, well, if everyone in the US has a computer, then the power that's necessary for that is going to be immense. And we're going to see electricity demand grow at a 13% CAGR over the next 10 years. And electricity demand from 2000 to today is pretty much flat. And I think that that's because that kind of analysis discounts the innovation, right? Where if a technology becomes intrinsic to day-to-day life, what you'll see is innovations that make it possible to have the capacity to use that technology. And I think that's probably what will happen on the power side here. You have something like Vistra, which, I played on the way up because I'm definitely not someone who shies away from just like solely narrative-driven price. But the idea that something like Intel, they're the only foundry that's going to be doing, if they deliver on their promises, which they haven't historically been great at, but they're the only one that's going to be doing what's called ribbon FET and backside power delivery on the same chip. You get into this calculating what's called, flops to watts, right? Basically how much compute can you do for the power you're using? And, I think Intel's pretty well positioned there, and you look at the stock and it's all a margin of safety thing. You have a narrative that could materialize, and then you have a reasonable margin of safety. And, I think that those two, that's what I'm trying to do. I'm trying to narrow this down to places where I don't have kind of this asymmetric risk like I would have if I was still holding Supermicro.
Got it. So you said TSMC, that is Taiwan Semiconductor, a world's leading producer of semiconductors, and they actually are a foundry. They make the chips, unlike Nvidia, which is a fabless thing. They design them. They do not make them. Is Intel kind of just like an American Taiwan semi that is perhaps slightly less competitive?
I mean, I'm sure if Pat Gelsinger heard you call Intel an American Taiwan semi, he would be real happy. But but essentially, that's one way of putting it. Where even though it's an election year, I've been focused on what are the priorities going to be, regardless of who wins the House, who wins the Senate, who's the president, and something that is pretty obvious from both sides is basically chips. Right? You could make a lot of heated debate over who has better technology, who is better in this area or that area with the US and China. One area where it's kind of unequivocal is AI and machine learning.
Or America is leading.
Yeah, absolutely. But it's still in a way where, Nvidia doesn't exist without TSMC. And it's something that we absolutely want to have very advanced foundries that are located in America. So I think that there is also kind of a fiscal tailwind for Intel, regardless of who wins. And so that's another kind of margin of safety there.
Got it. And people who subscribe to their Substack, which I recommend people do check out, and they actually see your baskets, they will learn, as I did, that you're a lot more diversified and you have a lot more names than people who just follow you on Twitter or listens to this podcast or the Odd Lots podcast may see. It's not just like Nvidia 25%, SMCI 25%. You were very diversified. How much dispersion, is that the fancy word, have you seen between the names? So for example, I know in the S&P, it has been a very narrow rally, unlike the rally of 2021, when it was the small cap, speculative stocks leading the way. It really has been Nvidia, Meta, Google, the other giants leading the S&P 500, and the Russell, comprised of the small cap stocks, is not doing great at all. Your comment on that, one, and two, have you seen that within your names where it's, I thought that each of these names would be up 15%, but really most of them are flat, and one of them is up a ton?
Not really. I think that there are certainly names that didn't perform as expected. As far as the this is kind of a two-part question, but as far as diversification goes, I kind of view it as being diversified on a security level, but concentrated on a thematic level. So the way that I think about it is essentially, it's varied over the past year, but between 10 and 20% of my book in artificial intelligence, right? What I want to avoid is essentially a theme that moves so fast like AI does. And then there's a development, where it significantly affects a single security that I'm concentrated in. And that doesn't mean that I really shy a ton away from concentration. Celestica, SMCI, AOI, at one point, these made up anywhere from 2 to, even 10% of the portfolio in a single name.
But that was not because you bought 10% of it. It was because it started off as a 1 or 2% position and it went up so much, correct?
Yeah, exactly. And the idea that Nvidia has been kind of like the sole beneficiary, I can see where people might say that if they're looking, at the S&P, and then you get the whole S&P 493 versus the S&P 7. But there have been plenty of good returns to be had elsewhere. If I look at like a waterfall of the contribution rate of every name in this basket, Nvidia obviously is pretty up there, but it's, it shares that spot with a lot of other names like Vertiv, for example, Credo, Arista Networks, Oracle, Amazon, Amphenol, Fabrinet. This is the point of the strategy that I use, which I think, people kind of are taken aback by how many securities there are. But the thing that I'll always say is if you own the S&P, you own 500 names. And if you can just own 300 and end up outperforming, that's pretty good, especially when it makes it so that your drawdowns are not life-threatening.
Yes. And so that is important consideration that you are diversified in number of securities, but not thematically. And so, like if someone owns a lot of real estate in China, it's not all of their hopes are on one property. But, if you own apartment buildings in Shanghai and in Beijing, they're correlated. And, Broadcom and Nvidia have been correlated on the way up. And if you go down, these your names probably will go down together too. Forward guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar Wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. Any final comments, Citrini, before we move on to the main topic of our discussion, which will be, drumroll please, the election?
Yeah, well, I figured, right, that since everyone was so kind of angry about me being super bullish on AI the first time that I came around, that we could talk about something a little less controversial, like U.S. politics.
All right, let's do it. And with the caveat that I, on this program, don't talk about politics unless it impacts the financial markets, because I know, some part of my audience is going to be on one side and another is going to be on the other side. And if they met each other and started talking politics, they probably wouldn't agree with each other very much. But they do agree with me when they're listening to me, about listening to Joseph Wang talking about quantitative tightening, or about the, construction of the CPI index. So I think that I intentionally shy away from politics. But in this topic, it is coming up, and it undoubtedly will have an impact on the fundamentals of markets, definitely, and probably on the short-term price action, probably, not definitely on that. And you really are perfect to address that, because that you say you have no political beliefs whatsoever. You only care about you only focus on how the election will impact different types of securities, different currencies, interest rates. And, it is very speculative, but, if Trump wins, what asset's going to do well? You've created a basket. If Biden wins, what's going to do well? You've created a basket. Tell us about your process in how you even constructed these baskets.
The reason why I try to focus so much on policy is because I think that the idea of getting an edge from just, when you look at, for example, the Inflation Reduction Act or the IIJA or the CHIPS Act, there is a real discernible edge in just reading those documents and finding out kind of all that money that's spent. It ends up going to someone, right? And a lot of times those someones are publicly listed companies, and there's a direct impact on their earnings. So, a good example that I use is you have a company called Encore Wire. And then in the Inflation Reduction Act, there were a lot of, green tax credits. And part of those green tax credits was something called the domestic component requirement, where if you're building a, efficient building, when, as you can see, like infrastructure investment has performed a lot better than most other areas, all these build outs, you're going to need to put in American-made components. And that goes beyond just, assembling the component in America and putting it in. It also includes basically sourcing from companies that are doing this in America. So you look at the options for basically copper wire, and the biggest one that produces their copper wire in America was Encore Wire. So if you're going to build a efficient building, you're going to need a lot of copper wire, and you're only going to get the tax credit if you buy from a domestic component requirement company. And so you look at how Encore Wire reacted after the Inflation Reduction Act text came out, and there was a delay basically while people began to understand this. So I focus a lot on policy because you look at how Encore Wire has performed. I think it's up 150, 200% since then. And with an election year, I just think that listen, forecasting elections is a lot harder than forecasting stocks, and I'm not someone that's going to tell you who I think is going to win the election, but I come in with kind of a Boy Scout mentality of just, be prepared and be ready for whatever tales might surface. And I look at the election in essentially two phases. where in this kind of first stage, you have the market reaction to the rhetoric from, presidential promises or debates and what politicians say they're going to do. And that has a lot of market moving impact because people want to be positioned for that. And then you have the actual outcome and how that will affect markets. So what I've done is essentially created two strategies. And the first one is playing anticipation of the election and playing what's likely to be said or what has been said, how people will react to, when I wrote it, rising Trump odds. Typical example there was Trump came out one day at one of his rallies in February and said, if you're a NATO member and you're not, paying your fair share, Russia can do whatever they want to you. And the idea that forcing these kind of NATO companies to meet their obligation to spend 2% of their GDP on defense, that was a huge delta, or represented a huge delta for European defense companies where, countries were absolutely not paying that. So for a while, that was, my way of playing the election, just long European defense companies. And then as the election drew closer, I started saying, okay, let me kind of separate this out into where I think there could be outperformance as we get closer to the election. And then on the other side, there's the actual impact of whoever ends up winning. And the two areas that I think that really will show itself is basically A, trade policy, and B, tax policy. So that's pretty much how I've approached this so far.
So you have a bunch of different buckets within your election basket. So for example, on the defense side, if Trump wins, that's the basket that benefits from Trump winning would be long European defense stocks and short US defense stocks. Then there's winners and losers from increased tariffs. Then there's bets on Trump specific securities such as his SPAC, Fannie Mae, Freddie Mac, which some investors think that Republicans are more likely to deregulate that or re-privatize Fannie and Freddie, which got taken over in 2008, of course. I think Republicans are more likely to do it than Democrats. The question is, are they likely to do it? Trump didn't do it in his first time.
Yeah, I don't actually care if they actually do it. That's the thing is basically just playing the expectation of it, right? So this is basically a basket that's just solely, the purpose is just to play election expectations. So if Trump's odds are rising and there's a higher chance of essentially, there's a higher chance of Republicans doing it than Democrats. I actually don't think that they'll do it either. But that doesn't mean that if there's a higher chance, then the securities probably should price that in, right? So stuff like deregulation of the financial sector, mergers and acquisitions, in a Trump scenario, immigration, that's kind of a classic one, and then the other thing is basically, I think that no matter who wins, there's going to be some sort of protest or whatever. So I found a name that basically makes the storefront glass for like retail. And that seems like that'll do well if there are protests.
Because the glass will break and the store will have to buy more glass.
Yeah, I think so. But, the really interesting one, I think, is kind of onshoring versus nearshoring. If you look at kind of the way that the Democrats have approached the pivot away from China versus the Republicans, the Biden administration has definitely favored nearshoring, especially to Mexico. And I think that the Trump administration would probably view that unfavorably because of the negotiating leverage that it gives Mexico. And, their stance on illegal immigration would also factor in. But, onshoring, the idea of not shifting from using one emerging market to another, but actually bringing production domestically, I think that really that's only feasible for a first world country if you make significant progress in automation. Offshoring or nearshoring has solely been driven by labor cost differences. And you're not going to get that benefit if you try to, onshore production of whatever it is, vehicles or precast concrete or whatever that is. So you look at kind of like the way nearshoring has played out in Mexico, and, it's been great for them. But if Trump gets in, I think that what we'll see is probably a lot more spending on kind of industrial automation, equipment providers, advanced manufacturing, and you could see a lot of America First kind of policies about supply chain resilience and trade tensions and get some losers in kind of, Mexican manufacturing and logistics. And then on the macro side, I think there would be some implications, obviously, there for inflation. I'm not going to go too far into that, but the one macro view that I'd say I'd have on the election, I think that if Trump gets in, we'll probably see one of the most epic 2s10 steepeners in the history of 2s10 steepeners.
So you have an epic steepening in 2s10s, the spread between the 2-year treasury, the 10-year treasury, or the 10-year and the 2-year. Now it's inverted, 2 years higher than 10-year. You think that would change? Why, if Trump got elected?
I think basically what you'd see is, I don't know if you read Nick Timiraos's book, $1 Trillion Triage.
Oh, yes. It's great.
Yeah, great book. And really rare opportunity to have a sitting Fed chair, then have, such an extensive look into his thought process and his values. And that was really very helpful in the fallout of kind of Silicon Valley Bank and the regional banking, whatever you want to call it, brouhaha crisis, whatever, because you could basically go through that book and control F, like banking crisis. And you would see what Powell thought, during I think it was the savings and loan crisis, where, Powell had this mentor, blanking on the exacts of it, but he was very pro not letting the banks fail. And, so it really, if you haven't read it, I would say it's definitely something that you should take a look at. But I think that one of the interesting parts of that was this, contentious relationship before COVID, obviously, of Trump and the Fed. And, that's not a secret to anyone. But I do think that the political pressure for the Fed to lower interest rates would be extremely significant. And I do not think that there would be, that there would be some degree of caving on that. And at the same time, you have, Trump's policies, which are basically cutting taxes without cutting spending. And you have this kind of trade policy, tariff stuff. It's all pretty inflationary stuff, and obviously dependent on whether the economy can absorb that. But I do think that in the beginning, what you essentially have is the bond market saying, well, if that's the case, then why wouldn't I just own the front end? And so I think what you could end up getting is basically significant drop in rates on the front end, and with kind of rates on the long end staying the same or even going up, kind of a bond market revolt. So I think that's like my one, I don't really have a view on like, how does the dollar do if Trump gets in, or, Biden or whatever. But as far as the yield curve, I think that if Trump wins, we get a pretty significant steepening.
The U.S. fiscal deficit was large, ever since 2002. Under Obama, 2008, the economy clearly needed a giant stimulus. Trump, as a Republican, when he was elected in 2016, ran a large pro-cyclical deficit with tax cuts. Then a huge amount of fiscal stimulus in 2020, again under Trump, but of course that was for the reason of the pandemic. Biden is also running a very large, smaller, but still very large. And again, you could say that maybe Biden's deficit now is more large than Trump's was, with the consideration relative to the circumstances, because we're not in a, you have unemployment rates not at 20% now. In the same way that you could say Trump's first, deficit in 2016, that was a deficit when the economy was expanding, unlike when Obama got elected, and clearly there was a need for massive fiscal stimulus because the economy was in a deep recession and getting into a worse one. So what is your outlook now on how large the fiscal deficit will be under Trump and Biden? And a reminder, our viewers, a fiscal deficit is just the difference between how much the U.S. government spends and how much it takes in taxes and tariffs. Since 2000 and 2001, the U.S. has been running a deficit, and really since the 1950s, most of the time the U.S. is running a fiscal deficit. We're a supplier of dollars, the world's reserve currency, to the rest of the world. But the deficit has been increasingly large, and of course, the deficit every year gets tacked onto the debt. So just explaining that for the audience, what is your outlook on how large the deficits will be under each president, whether they're elected?
You said something interesting before I answer that question, but the idea of when the trickiest part of this election is essentially that, it's a rematch, right? And that kind of makes it very tempting to just go and backtest, well, how did stocks do when Trump was president, and how did stocks do when Biden was president, and then call it a day. And, that's not going to work. It's first off, obviously, the economy and external factors are much more important than whoever is president. The places where election kind of focused strategy will work is going to be more in the micro side, I think, than the macro side, just because you want to be very specific about the areas where things will be different. This kind of gets into the idea of not playing the expectations surrounding the election, but playing the actual outcome of the election. And that has a lot more to do with, like I said, trade policy and tax policy. And I think that we have entered firmly into a dirigistes bipartisan consensus, right? There's
what does that word mean? You use it in your piece. What does that word mean?
So there's two sides, right? Laissez-faire and then dirigiste, right? And laissez-faire, in French means kind of like let alone, just like let the market do what it will. And that used to be kind of the policy of the GOP, where state intervention for curbing inefficiencies or whatever, doing counter-cyclical stimulus, it was much more kind of let the market sort it out. And obviously there's still differences in how these parties approach it, but dirigistes is kind of the opposite of that, where you have a very involved government. It has like indicative planning, government credit policies, subsidies, kind of fostering the areas where you think there's going to be the most productivity gains. And both sides are profligate spenders. There's the era of like the conservative fiscal policy, I think, has been disrupted by the paradigm of the U.S. increasingly kind of being a little more populist, where you spend money because you want people to vote for you. And that's I don't know if that's cynical or whatever, or if maybe that's my own political bias, in the sense that like I don't favor either party, but it is something that I think we have seen very significantly. And I think that the deficit, that's one area where it might be a little larger under Trump, but ultimately the offsets of like the tax policy differences. One of the first things that's definitely on Trump's agenda will be extending the TCJA, which is the
Tax Cuts and Jobs Act.
He has a very kind of aggressive tax policy where you're going to do tax cuts and you're cutting the corporate tax rate, and you're extending this kind of the like 100% bonus depreciation in the first year, and then on the Biden side, it's a lot more aggressive, where you have, raise the corporate tax rate to 28%, quadruple the stock buyback tax to 4%, eliminate tax subsidies for fossil fuel and real estate and executive comp. And then you had, Janet Yellen. There's the global minimum income tax, for corporations, GILTI. It's currently under the TCJA, there are incentives to repatriate foreign income, but that expires in 2025. So Yellen has expressed hope that Congress will basically admit us to these 140 country signatories, where no matter what you do, like for example, big pharma, they have a tax loophole that I think is called single malt, which is basically hiding your intellectual property kind of revenues in Ireland that's owned by a company in Malta. I don't know. I'm not an accountant, but there are all these loopholes where you can kind of shift overseas, and that would be the tax burden on companies would be pretty significant. So what I've done is I've looked at what were these companies' effective tax rates, between the time when the TCJA came in to 2018, just to like eliminate the COVID kind of. That's the thing. If you're analyzing these two things, you really have to just take out COVID, because this was the biggest, bipartisan thing ever. So before the CARES Act, basically. And then examining, who were the biggest beneficiaries of kind of the Trump tax plan versus who were the biggest beneficiaries of Biden's tax plan, and who was hurt and by either. So I think that that's kind of an area where you can really anticipate well, because it's pretty clear what they're going to do from a tax policy perspective. And while large cap companies don't really trade on after tax earnings, it does make an impact of how much money people have and how much money these companies have to kind of invest and do CapEx and do R&D. I think that when you're talking about forecasting the deficit, I don't really know. How does it play out? Does Trump's tax policy make it so that since there's more money to invest, that we get more productivity and the government gets more tax revenue, and or does cutting taxes while spending the same amount, which I'm pretty sure he will, does that increase the deficit? I don't really know, but what I do know on the tariffs and tax policy, those are two places where whenever the outcome comes out, that's what I'm going to be playing, because as far as I don't know if you've seen the tariffs that are proposed by Trump, but they're pretty aggressive. It's like a 10% tariff on anything that's not U.S. made, and then like 60% tariff on some Chinese goods. All of this kind of informs also, how I want to be positioned in China, right? Where I don't know if you saw recently Michael Pettis on did you see that?
I did, yes.
He basically said that we're nearing the third plenum, and we are increasingly likely to see Chinese consumer stimulus, right? We're like stimulating consumer demand, basically like helicopter money, or probably not as extensive as what we did during COVID, but the general idea is basically you have this situation where consumers aren't levered up that much, they're not spending that much, and the household savings high, so you kind of incentivize that spending. So I think that sets up pretty nicely where even if Trump wins in China, it seems like you want to be positioned for the kind of localization of the Chinese economy. And the idea that, if they are going to do that if the stimulus materializes and it looks a lot different than the previous Chinese attempts at stimulus, which obviously did not end super well, you can basically create a reasonable allocation. And this is the interesting part of how I run, or at least it's interesting to me. But the interesting part is basically how different themes kind of inform one another, right? Where my allocation in China is directly going to be impacted by what I'm thinking on the election, or what I'm thinking on AI, for example. There's a lot of really contentious stuff going on where China, if we're constantly saying, okay, China, you can buy the generation of chips that's two below, whatever Nvidia has out right now, they're not just going to say, okay, cool. They're not going to just relegate themselves to constantly being at a disadvantage in this technology. So I think when I first put this China trade on, which the last time I was on here, I think I was complaining about how badly it had done, but it recently has, for a little while, very small amount of time, but for a little while, it was outperforming NASDAQ since I had put it on. I think that is back to underperforming the NASDAQ slightly, but performing about in line with the S&P. The way that I look at it is from the AI side. Okay, I'm going to focus a little more on the necessities of China having to build out its domestic semiconductor industry, right? Do I think that they will necessarily be successful in whether it's focusing on ASICs or trying to create a GPU that I don't know, but what I do know is that they're going to try. And if you look at Japanese exports of semiconductor capital equipment, semicap, to China, that line has gone parabolic, right? Because China realizes that the only way that they're going to have some independence here and not be beholden to a U.S. company, which is distasteful for them, is going to be by doing their own build out and trying to basically create something that puts them a little ahead. Do I think that China will ever, or in the next 5 years, will create something that's better than what Nvidia has for the purposes of doing AI and machine learning? Probably not. But can they create something that is better than what's needed to, exceed what they're allowed to buy from the U.S.? Or can they focus more significantly on whatever inference or another area of AI or custom silicon? This is all super interesting, and it kind of informs how all these themes, fiscal informs playing the election, and informs kind of AI through the CHIPS Act stuff, and China informs AI, AI informs China, and So I think it's this is like what I personally love about it, right? I love like this like massive puzzle, and sometimes you get moments where you kind of see where the pieces are going to fall, or at least you think you do, and that's my favorite part of it.
And we'll talk about your China basket in just a sec, but you have a basket of companies that benefited from the TCJA, the Trump's tax cut when he was president, where you look at what their tax rates were before the TCJA and then after. I'll just take an example.
Good example of like how hard this stuff is to predict was the performance of like clean energy stocks versus energy stocks when Biden got elected. Because it's like if it's 2021 and you're sitting there and you're looking at a Democrat win instead of a Republican, and you know what the Democrats' priorities are, and you say, all right, well, if a Democrat's getting in, that's probably not great for energy, and that's probably pretty good for clean energy. So I'll go long, ICLN, and I'll go short XLE. You would have gotten destroyed, right? And that's like a great example of how the economy is always going to be the macro economy is the primary driver, and that's a lot more important than who wins the election. But so you have to be really selective about not just doing these kind of blanket things and blanket assumptions of what the Republicans and what the Democrats are like, and finding areas where there's an outsized impact from specific policy rather than just how you think things will do because X, Y, or Z, administration.
So the other themes are, you call it idiosyncratic Trump beta, which is just stocks that are associated with Trump. So Fannie Mae, Freddie Mac, Rumble, conservative app, Trump SPAC, Trump crypto tokens or NFTs, although I don't believe that those are part of it.
That might be an interesting thing to talk about because it's I don't know if you saw recently, Trump came out and was like very supportive of crypto, right? And so the most interesting part of this that really in hindsight is pretty obvious, but the Biden administration does not want crypto to become a single issue, right? Where it's like that's an issue where people vote along the lines of where everybody that owns a significant amount of crypto is going to say, well, here's how I care about X, Y, or Z policy, but a lot of my net worth's in crypto, so I'm going to vote for Trump. So what you saw right after that was the approval of the Ethereum ETF by the SEC. And I can literally imagine the conversation that was had between, Biden and Gensler, where he probably just called him and was like, listen, I do not want to become the tough on crypto candidate because that is not going to fare well. So you have to get something done here.
Republicans are coming out in support of crypto. Paul Ryan, very notable deficit hawk back in the day, talk about how we're printing so much money, we're borrowing so much money, our grandkids are going to be saddled with debt. Now he is, a stable coin promoter and talking about how stable coins are necessary because they can help us increase the amount because stable coins will buy US Treasury debt, which is true. But it's interesting, he's kind of acknowledging that there can be the private sector can print money to buy the government paper that the government prints when it borrows. So a little maybe inconsistency there. And it's similar to banks can just buy debt and then issue credit against them. What do you think of just about the pure S&P 500, the stock market? Does it do better or worse under Trump or Biden, and why?
I don't know, but I have thoughts. I have thoughts that are kind of contingent on specific things happening. I think it's going to depend what Trump can get through on the trade policy side. I can tell you for sure that, if Trump got everything he wanted on the trade policy side, I don't think that like the tax cuts and kind of, supportive policies would be enough to offset the inflationary impulse. But so I think that really that's something where we're going to need a little more information leading up to the election about, exactly where their priorities are and kind of it's going to that probably will be a lot more driven not by who wins the presidency, but by what the House and Senate are, because stocks do better historically under divided governments. So I think that probably the best outcome for stocks would be Trump presidency and then basically Democratic control of the Senate. But again, I don't necessarily have a strong view on that yet.
Why is that? If stocks like large fiscal deficits because they're stimulative to the economy, wouldn't the scenario where you'd have the largest fiscal deficit be a Republican in the Oval Office and running the Congress, or Democrats in the Oval Office and running Congress?
Sure, yeah, and that gets into kind of an interesting question of right, inflation. Is inflation bad for stocks, or is the central bank reaction bad for stocks? Right? Is it actually, because inflation, probably inflation itself is not the worst thing for stocks. If you look at the 70s and like the period of time where the Fed could kind of like Burns reaction, there were years of pretty good returns in there, but it was obviously the Fed's reaction to inflation that drove stocks down.
Yeah, but just because I think you're right, there were years of good performance in the 1970s, but I think the 1970s was one of the worst performances in real terms, one of the worst decades for stocks, probably even worse than the 2000s, which included the great financial crisis.
Well, but you look at companies' margins in like the in the beginning, especially during the like 1973, 74, as inflation went up, the margins on the S&P went up as well. And so I think that you would have to basically answer, how much can Trump bully the Fed, right? If you get like this large fiscal stimulative pro-cyclical fiscal deficit, again, all of this kind of comes back to the actual effect of the election on the overall economy, which I think really is not extremely significant. The place where I want to be positioned is in the micro side, right? I want to be kind of hyper focused on the impacts of trade policy and tax policy on kind of collections of single companies, and as far like the overall economy is going to be much more important, and that is kind of where you get this disconnect of like, well, what are stocks going to do? You could have said any number of things about how stocks are going to do under Biden or Trump, or so. The thing is, predicting the entire stock market off of just a single election is going to lead to some pretty wrongful conclusions versus just trying to predict kind of the impact of specific policies. A good example of this is, imagine it's 2021 and Biden has just won over Trump, and your conclusion is, well, the Democrats are a lot more accommodative of clean energy and they're not that friendly to fossil fuels. So I'm going to go, long clean energy stocks like ICLN as an example of an ETF, and then I'm going to go short energy, XLE. You would have gotten destroyed, right? The returns would, I have a chart of it, but it's pretty much down only, and that's a great example of saying, oh, Trump wins and then stocks go up, or Biden wins and then this happens. The broad kind of index is always going to be driven more so by what's going on overall in the economy and a bunch of external factors. And that's why I think that really the risk reward here is probably in just playing specific kind of policy decisions.
Citrini, you have created a basket. Interestingly, and I like this, the basket that you haven't put on a lot of these trades yet. The basket that you've created that is a back test. So when you didn't have these positions on, actually it tracks, but it doesn't track that well. And I actually kind of like that, because what drives me crazy is when people say, I've created this index going back to 1980 and it tracks this thing perfectly over the past 40 years. So if we had a time machine, this would, but it's not in sample. You have to track it from when you actually have a position on, because you're going to be back testing until you get the back test that you want. And it's not easy, but it takes a while, but it is doable to just create the perfect back test. So I actually like that your back test doesn't look that great, especially that the trades that you actually have on, such as AI, those have tracked AI fiscal beneficiaries extremely well. So I do think that as I called you in our first interview, the title, the world's hottest stock picker, a very talented stock picker who's trying to pick a theme. As you acknowledge, this is an incredibly hard task. And so I'm just going to ask you somewhat of a challenging question. Like, you have a Tarriff Basket. So you have, let me just find this, our house. You have, for example, long tariff winners. You have BJ Holz Clubs and our house. They produce a lot in the US. And then there's your short basket for those short tariff losers is Target and Nike, which produce a lot of stuff outside of the US. How are you trying, like, let's say if 5% of the price delta in Target and our house are based on this factor, how do you isolate that from the 95%? Like, let's say there's just a huge boom in consumer spending that benefits our house and Target, or there's a contraction that benefits both. How are you trying to isolate that factor? It seems very difficult.
That's where the basket composition comes in. And this is an evolving thing. We'll see. It's going to be based on, rhetoric in the debates. And I think that you kind of get a little bit less risk of just, well, what if this single company is able to diversify more away from China, or they anticipate that the tariff risks will be higher. This is where having that diversification within kind of a theme works out. So, for example, the tariffs would be long BJ's, long Ross, and like the long Becton. A good example is like Becton Dickinson, right? Like long Becton Dickinson, and then short CAH, and that's because of like specific tariffs on syringes, basically. And the thing is, like, the bipartisan agreement on U.S. protectionism when it comes to China, it's pretty significant. There's no real China doves in the government anymore. So the way that I kind of view this is, I'll look at Biden just passed some tariffs on China that were a lot more specific than what Trump's would be. But if I can create a basket of stocks with longs like Becton Dickinson, and then short like Cardinal Health, and have this kind of exposure where it will likely get impacted by tariffs that are already existing under Biden, that will only get expanded under Trump, that gives me another kind of margin of safety. And as far as I'm not going to outright just short Nike because of tariffs, but in a collection with Target, Restoration Hardware, Floor and Decor, these are, it creates an overall kind of smoothed out where you're more accurately playing just tariffs rather than specific company decisions.
Got it. And then how do you think the tariffs on Chinese vehicles as well as European vehicles is going to impact American car manufacturers as well as, like, let's say Tesla?
Yeah, that's a pretty interesting one. I mean, it seems like Europe originally was a little more accepting of the Chinese EVs, and they might be pivoting a little bit away from that. And I think that have you seen one of those electric vehicles?
A Chinese one?
Yeah.
I have not.
Oh,
I know they're very cheap though.
They're super cheap, and just like even better than the ones we have here, and it's kind of, I mean, it's a shame really that if you look at what happened with like Japanese imports, it kind of elevated where you can't have one country that's, constantly just sending these cheaper vehicles. Eventually, like, the domestics kind of have to keep up. But I mean, Tesla has always been pretty good at playing, whether it's government subsidies or government policies. And that's something where I don't think that the U.S. is never going to let in these Chinese EVs, because it would completely destroy the U.S. electric vehicle market, just because there's no way to compete. They're so far ahead on production. And so I think that the Chinese kind of electric vehicle market, it's probably going to stay in China.
So, Citrini, there are some people who would consider you, to have this guy's focused on AI, pie in the sky thing. So I want to ask you about, what do you think about the Tesla's as an AI company, and Tesla as a beneficiary of Robotaxis, as well as the most recent ARK open letter, where the current stock price of Tesla is, let me get it, $178. So ARK has an expected value in Tesla in 2029 of $2,600 per share. Their bull case is $3,100, and their bear case is $2,000. Again, I repeat, the stock price now is $178. So their bear case is a 10x. What do you think about Tesla? I haven't really seen Tesla in any of your baskets.
This is great, Jack. I like how, you had me on when everyone hated AI, and I got to be bullish on AI. And now I get to alienate all the real super bulls who are also bullish Tesla, because, Tesla's a car company. I think that the Robotaxi thing, I said back in, even before I was on the podcast the first time, I said you want to be long AI and short Tesla, and so it was good because I got to really piss off the kind of bears by being bullish, and then really kind of alienate everyone that was also, you know, very bullish because they were likely to be bullish Tesla as well. But you know, Tesla is. How can you be involved in a company with such like crazy governance? The idea that I think Elon Musk saying basically, well, I'll take my AI efforts elsewhere. It's, you know, can you be an AI company if you're like constantly under the threat that if you don't pay this guy enough, that, you know, although I will say that with the shareholder meeting, I'm pretty sure they'll vote his way. And I think that's probably
They did. They already did.
Oh, okay. Yeah, there you go. I think that that's actually, I mean, that's reasonable. Like you made a deal. I'm a business person, right? And if you say to this to your CEO, listen, here's these crazy, ridiculous targets that everyone on the street thinks are just insane, but if you hit them, we're going to pay you a absolutely wild amount of money. If you agree to that, then, you know, you have already agreed to that. Do I think that, you know, being able to keep Elon Musk incentivized is going to really elevate Tesla to the level of like AI competitor? No, I don't think so.
Why not?
I just think that the hyperscaler environment right now, and also just the environment of AI and companies like that, it's you know, just to go off on a little bit of a tangent, I think that when you look at the landscape right now, and all of these gains that have kind of accrued to the hyperscalers and this like fierce competition in AI.
So a hyperscaler, just for the audience, how do you define it? It's like a huge cloud company like Amazon,
Apple, Microsoft, Google, Amazon, yeah. What I know, this is a little bit of a tangent, but something that I wrote recently, you know, at the end of May, was that what we're going to see now is that competition has to heat up, because the way that it looks like AI is progressing is essentially going from, here's ChatGPT, and, you know, you can use that as a productivity tool, and here's like all these various startups and everything with their AI tools. But the real value of AI is that, you know, the hottest new coding language is English, right? And being able to interact regularly and effectively with words, with you know, like an AI assistant, and have an AI assistant that is using whether it's agents or these kind of quote unquote specialist models that are really aggressively focused on, they're smaller models, but they're really aggressively focused on specific tasks, and being able to walk down the street and not and work and not be on your phone and looking down, and just have, you know, an earphone in and say, hey, you know, what was that meeting that we had last week about so-and-so? And then it tells you, and you say, oh, okay, you know, let's email that guy. Let's find a place in my schedule where we can do that. And then as you interact with this, it's going to increasingly kind of get to know you better and get to anticipate your needs and do inference and be able to kind of infer things. And if that's where we're going from here, the biggest component of who wins in these companies for kind of consumer and even B2B focused AI, it has a lot to do with trust. And when you look at a company like, say, you know, Google or Apple, right? And Google has, the stock price has pretty much shrugged off these kind of faux pas that it's had with AI. I don't know if you have been following this.
I have. On
June 2nd, I published that we were going to sell Google in our AI basket and go long Apple, and you know, that worked out pretty well with the WWDC. And I think that what we're going to see from here is basically there's going to be more dispersion in the Mag 7 because of this. And you know, so if you ask me like, well, you know, how is Tesla not an AI company? Well, you know, I don't really think that Tesla has a real kind of expanse of trust that it can tap into. It obviously has a very passionate user base. But it's kind of have you ever seen the movie Gattaca?
Yes.
So the way that I think that this goes forward is basically, if you are not using AI and you're not kind of listen, not like right now, although maybe in some areas right now, but as AI progresses to kind of this AI assistant, agent, whatever you want to call it, there's going to be a point in time where if you're not using it, your productivity will be so much worse than the next guys. And that's why I think that these products are going to be unbelievably sticky, right? Because of that kind of inference that it's doing, where, Apple has the potential here to, do you know what single sign-on is?
No.
SSO. So, like when you go to a new website and it's got something at the bottom that's like sign in with Google, sign in with Apple.
Yeah.
So if you could imagine like an SSO, but like for your entire life, where you have this one ecosystem, and that's where it kind of knows everything about you, and it can anticipate your needs. And so whoever kind of wins this, not that it's a zero-sum game, but there is a certain aspect of that where whoever makes it so that you have an AI tool that is going to be better at knowing you than any other solution, even on, like I said, on the business side, where something like Salesforce was positioned to be like a pretty significant AI beneficiary, but it's also really exposed to this kind of AI, and for instance, just anyone being able to have your own CRM and have AI do that instead of having a specific solution for it. And so these ecosystems will be created, and I don't think that Tesla is going to be the one to do that.
And yeah, CRM, customer relationship management, also happens to be the ticker of Salesforce, which has historically been an excellently performing stock. There has been a bear market in software that I think has taken a lot of people by surprise. And is it because the reason you just mentioned, that why do I have to pay some company, $100, $1,000 a month to do this advanced processing when I can just download a chatbot for free or very free? And
I don't know.
And
the software bear, you can, is it AI cannibalization? Is it that there are so many variables here about why software has underperformed? It's very difficult to nail down a single reason why, but I've also kind of played my hand with software, and it was very underrepresented in my AI allocation. And the reason why was because back in June, I basically said that it would be too difficult to anticipate who's going to win and who's going to lose, because it's not so much about having upside because of AI, it's about not having downside. And when you looked at all of these gains accruing to the hyperscalers, and you had all these software companies, if you were going to say, oh, who's most likely to be harmed by AI? Well, in the long term, a lot of software companies, and I did include a couple of them, but as I've narrowed it down, I've focused a little bit away from that. I think that you have the luxury right now, basically waiting to see which of these software companies can kind of integrate best. I think that Cloudflare is kind of interesting, just from like the CDN cybersecurity angle. And I'm not someone that's going to be buying 52-week lows. I think that the amount of money that's been buying off the 52-week low list is really just astronomical. I would much rather live by that, the Jesse Livermore quote: the most expensive move, the most expensive eighths of any move are the first and the last. And so I'll wait to see who kind of makes it out, because right now in software, there's going to be some amazing buys, but there's also, maybe 30% of software companies out there right now are just donuts. And I don't really necessarily feel like rolling the dice on that yet.
And would you consider shorting any of these companies you consider donuts? What are some SaaS, software as a service, SaaS donuts that you have your eye on?
I did that already. Like I had like a AI winners and losers basket. And, when we got down to like October of last year, that was when I really, basically said to everyone, if you miss the first wave, this is the time where you want to. That was when I said on Twitter, we're never going to see below 400 on Nvidia again. Although I guess I was wrong because of the stock split. But that's around when I kind of covered the shorts in software. But some of the companies, like Expensify was one of them, and I don't really want to talk about that because it's like right now it's just so,
you're not short those things now.
Yeah.
Got it. You said something about the Magnificent Seven. So you think a lot of that will be in the Magnificent Seven. So the hyperscalers, which is Amazon, Google, and Microsoft, and Meta. And then there's Nvidia, which is selling them the hyperscalers, all of their stuff, which people have identified as a weakness, which is all of Nvidia's increase in revenue is coming from these companies, even though these companies have tons of money.
Yep, that's a serious risk to, and something that you, if you're playing this now, where it's not, the margin of safety has gotten extraordinarily diminished. You really have to pay attention to the efforts on the part of the hyperscalers to develop custom silicon and not basically make their own chips that can do this. The application specific integrated circuits ASICs, and also look at the efforts in China. Whether or not that's a possibility or a probability. I don't know, but it's something that you absolutely have to track, because what happens if Nvidia's kind of dominance in this is disrupted by that? I don't think that that's something that's going to happen in the next 12 months, but it's something that there's only so long that you can kind of maintain these extraordinary margins, selling the best in the industry. Like you look at, like, I don't know, we can like throw it back to history and look at like Portugal when they invented the arquebus. Like that lasted maybe 15 years of 90% margins from being able to make the only musket, but eventually you get disrupted, and that's not a if question, it's a when question. And the when is basically going to be, what is the extent to this? And obviously Nvidia is winning right now, and it's just something definitely keep an eye on, where you're kind of, well, how is this going to change?
And you talked about those companies, the hyperscalers' efforts to create their own chips in our conversation in late January or early February of this year. What progress has been made on that, and what companies are helping Meta and the hyperscalers do that?
If this happens, right, if tomorrow Meta, is we created our own custom silicon and we don't need to buy Nvidia chips anymore. I think you would want to look again, TSMC, right? Just because TSMC, probably Marvell, Micron. You're still going to need some of the same components to create these chips. So that would it would shift some of the balance of power to the suppliers for ASICs rather than the supplier of the finished product chip.
And in our second conversation earlier this year, you said that just because AI is a thing doesn't mean that semiconductors aren't cyclical anymore. Semiconductors are a cyclical industry. There's being a boom, there being a bust. Where are we in these? Do you still stand by that statement? And where are we in the semiconductor cycle now? 5 to 6 months later.
No, yeah, absolutely, I stand by that statement, and I think that that's you want to talk about like ringing a bell at the top. When everyone is starting to say, well, semiconductors aren't cyclical anymore, that's when you want to start getting worried. It's still going to be an economic activity thing, and all this CapEx spending, it's still related to, you have to have a certain kind of optimism about the overall environment to continue kind of spending this aggressively on new technology.
What do you think the odds are that this is the top in the AI type stocks?
Well, I think that that's a pretty interesting, that's a dynamic that's played out, I don't know how many times, where the buying pressure on Nvidia is basically driven by people who sold it 30% ago, who said it was too expensive then, and then are drastically underperforming because they're underweight Nvidia relative to the index, and then are forced to kind of buy it back. And then the people that are selling it to them are people who think it's too expensive now, and it's kind of this circle where the kind of price action that we've seen on Nvidia for the past couple months is something that it's not sustainable forever, obviously. And but it comes back again to the other side of that Jesse Livermore quote, where the most expensive eighths of any move are the first and the last. As long as Nvidia is going up every day, I'm not going to sell it. I will, and there are like periods of consolidation and stuff, and this kind of, when you get into like the mania aspect where it starts to get disconnected from fundamentals, that's when it just starts to become a thematic kind of trend following thing, where this is clearly in a very strong trend, and I'm not going to try to fight that. But I do think that there are going to be, especially from prices right now, there will be better opportunities for outsized returns. Just like we said on Micron in kind of back when it was trading at 70, and now it's at 140, and that's a double. And obviously you probably could have made the same return buying Nvidia, but what was your risk? not talking about ex post, talking about ex ante. What was your risk in, buying Micron when it's kind of like coming out of this cyclical trough versus buying Nvidia when, it's gone up every single day? I think that I'm not buying more Nvidia right now.
Can I ask you, what's your cost basis on Nvidia? You can either give me post-split or pre-split.
I mean, pre-split, it's around 250 to 300.
Okay. And so the split was 10-1, right? Or 9-1?
Yeah, 10-1.
10-1.
Yeah,
okay. So now it's at 13. So your cost basis, what you got in it was,
call it 300. Yeah.
300. So that's $30, and now it's at $130. So it's up quite a lot. And this is a thing that in finance, people who have a lower cost basis have different behavioral incentives than someone who buys at the highs. And likewise, if you buy a SPAC for $10 and it goes down to $1, you say, "Oh my God, there's no way anyone would ever sell it at $1." But if you're part of the company and you got shares at 5 cents or a founder share, you would sell. So that cost basis thing is important. What would you have to see for you to become bearish on Nvidia? Because going back to our first conversation, James, you said that this is a bubble, and to quote the George, you're a big fan of George Soros. When you see a bubble, the first thing you do is buy. You saw this as a very
no. Jack, when you see a bubble forming,
yes,
right?
correct. Yeah.
That's the bid. That word does a lot of heavy lifting there because
yes.
I think if you said it that way, when you see a bubble buy, that to anyone who bought the top in 2000, they're gonna very significantly disagree with you.
When you see a bubble forming, yes.
Yeah, when you're underwater on Microsoft for 13 years, and then there's, like you said, the behavioral incentives and how likely are you to hold Microsoft underwater for 13 years and just dollar cost average into it. You need to be really talented and have a lot of foresight if you're going to do something like that. So, what would cause me to be bearish on Nvidia? In terms of the overall market environment, if we went into a recession, like I would be very bearish on Nvidia. If we in terms of like intra-thematic and kind of developments in AI, it comes back to basically disruption. And what's Nvidia has been the disruptor, and it's a very common theme where you go from being the disruptor to the disrupted. If there's signs that there are viable products that can kind of unseat Nvidia in this pole position, that's when you start kind of saying, well, on one hand, do I want to continue owning Nvidia? But on the other hand, what is the risk to the overall AI theme here? And because listen, I'm bullish on AI, period, right? But I'm still in the market, and if I think that the stocks that are going to benefit from AI, that in a year I'll be able to buy them 50% cheaper, I have no qualms about selling and getting back in, and that's something that I think probably will happen there over the next 10 years. There will be it's a market, right? And regardless of AI's progression, which it will be a technology that we all use in our day-to-day life. Right now, you can kind of make the decision whether or not you're going to use ChatGPT, or maybe you're in an industry where it doesn't really make sense for you to. Over the next 10 years, every single person in the world will be using AI. But does that mean that the stocks are only going to go up from here? No, of course not. It's a financial market. We will get way too optimistic, and then we'll get way too pessimistic. And so I'm not going to sell because we're too optimistic. I'm going to sell because we're too optimistic, and threats start materializing to that optimism.
And those threats would be a recession. So you divide the threats into macro and non-macro. A recession, yes, as a threat, spending goes down, as well as the non-macro threat to Nvidia is that all the hyperscalers create their own chips.
Yep, essentially. And also, or maybe China creates its own chip, and then China has the decision to make: do we keep this for ourselves, or do we sell it on the global market? And that's something, but although that is a whole different conversation about the incentives there and whether or not they would make that decision. That would take an entire other podcast to discuss.
Now let's go over to China. You mentioned you added some companies to your China basket, and specifically on the sub-localization of artificial intelligence. Basically, China can't buy AI chips, so you added a bunch of companies that are there. So Citrini, in your changes to your Chinese equity basket, I see 5 companies that I, as someone who is familiar with a few names in the Chinese stock market, have never heard of: Naura, Piotech, Hygon, Cambricon, and Huahong. Are these companies all in the AI semiconductor world, and why have you added them to your basket?
So we just spoke about basically hyperscalers and Nvidia having them by the balls, and that's not a great position to be in. Obviously, you're very incentivized to get out from under that, especially when you're running a business, or you don't want to just be at the mercy of a single company and to have that be your input costs. So consider that, but on a nation state version, right? If you're China, you can buy Nvidia chips, but you can buy the most advanced Nvidia chips, but not on the scale that you need to. Not with all the sanctions. Sanctions aren't 100% effective for anything, but sanctions on a product that has really, really significant demand in the domestic market here, you're not going to be able to compete really. Although I will say that they have been relatively effective in kind of finding ways around it, and as demand kind of softens for these chips and on the less advanced side, we'll see probably more of them finding their way to China. But still, this can be perceived for China as a national security issue, right? Like it's basically a state of emergency where if Nvidia chips are going to result in the U.S. developing military technology that can outplay them in a physical battlefield or a virtual battlefield, and they have no way of catching up and are constantly at the mercy of buying the second best chip, the answer is pretty straightforward, right? You have to create your own. And I mean, that's a pretty tall order. These chips are the result of decades of R&D with a unifying goal supported by deeply ingrained relationships. And, so basically it's kind of a unique situation because China can't just copy, right? They have to create their own. They probably have the exact specs, and corporate espionage is good enough where they probably know exactly what it is, but you need the actual infrastructure to be able to create these things. And so I see an environment where China's going to have to continue spending aggressively on WFE, wafer fab equipment, and redouble their efforts to create Chinese AI without this Nvidia handicap. And this goes beyond just having AI. It's also AI's development right now is very focused on the English language, and they have to. That's going to continue to be a thing until someone is properly incentivized to do something else. So, the best way to kind of describe ASICs is have you ever seen like a crypto miner, like a Bitcoin miner?
Uh-huh.
So it used to be, in the very, very early days, you would be able to mine Bitcoin on like your Celeron CPU, right? And like your Dell XPS computer. And then it evolved to basically you would buy a milk crate and you would stick a motherboard in it and some PCIe risers and put like a terrible CPU in it. And then you would just buy 6 NVIDIA, consumer GPUs and stick them on the milk crate, and that would be your crypto miner. And then some Chinese companies basically figured out that they could do this better. And you had companies like Bitmain and Canaan, and they created application-specific integrated circuits. And the application it was specific for was mining crypto. And, now that's still a function of floating point operations, and not to say that, if you can create a Bitcoin miner, you can create a AI chip that's going to be better than what you can buy, what you're allowed to buy from Nvidia. But China is going to have to make some very strategic investments, and they can't just spin up a few new fabs and churn out a bunch of knockoff Hopper chips. They need to create an entire stack, and that's an uphill battle, but it also involves a lot of domestic spending. So when you look at the Chinese economy and the likelihood of like Chinese fiscal stimulus, I think that what I've been doing with this kind of approach to China that has played out pretty well is what I've called the Chinese equity barbell, basically, where on the left side of the barbell you have supply side stimulus beneficiaries, and then on the right side you have demand side stimulus beneficiaries. And then for a while, what I said the bar of the barbell was we were short 3 or 4 times as much notional Chinese yuan as we were long Chinese stocks. And so I covered that, that specific aspect, but I'm still approaching it from there's one of two ways that China's going to do stimulus more aggressively. And right now it's looking like consumer demand focused stimulus would be the most advisable course of action, but they're still going to do a certain level of manufacturing stimulus. And if you're China and you're looking at, where I'm going to stimulate my manufacturing economy, am I going to stimulate the part of it that's primarily focused on exports and primarily, very exposed to maybe Trump gets in and now everything that those manufacturers are making has a 60% tariff on it when it's sold to America? No, you're going to focus on places that allow you to bolster your own domestic economy. And I think that the biggest area of this would be in AI chips and kind of fostering innovation and, keeping chips in-house and ensuring that you have your own AI ecosystem. And they're already doing this. If you look at a chart of Japanese semi-cap exports to China, it is a parabola, basically. And so what I've done is essentially, for a while, these names have been obviously getting slaughtered, right? And there's always a overhang and kind of a risk of
the 5 companies I listed, you said.
Yeah, there's always a risk of basically ending up on the entity list, like SMIC, which is China's TSMC. But I think that for now, it's an asymmetric bet where you just look at the entire ecosystem of like what the ecosystem looks like in the West, right? Where ASML, Lam, Applied Materials, and then CLAC, and then you look at kind of how is China going to bring this in country, and what companies benefit from that. So like Nara does deposition and etching, Piotech does chemical vapor deposition, and Hygon makes CPUs, and Cambricon is basically could be quote unquote Chinese Nvidia. If then you can't buy Huawei, but that's one of them. Huawei is a semiconductor foundry. So I think that that's right now that's primarily where I'm focused on the supply side of beneficiaries of whatever China decides to do on fiscal.
This could be off base, but did you get a chance to look through, or do you have views of the short report by Scorpion Capital on LaserTech, which is that person alleges is a colossal fraud and ticking time bomb, and I believe it's a competitor to ASML, and its customers are TSMC, Intel, Samsung.
That's the Japanese one, right?
Yes.
Yeah, I mean, I applaud them for like that's a colossal undertaking to do a short report on a Japanese company, and
300 pages,
yeah, and the way that like the governance works over there, and I mean that is a labyrinth. I haven't read it yet. I didn't own the company. Luckily, I think the most impressive short report I've seen ever was the Hindenburg Adani one. But I wrote something about kind of like financial history and talking about the Dutch East India Company, and a really great story about basically how the Cape of Good Hope was discovered because a guy had basically shorted the Dutch East India Company, one of the original like people in there, and it's too long to get into now. But the thing is, like, when you
is that Isaac Lemaire?
Yes, yeah, it was, yeah. So and I thought that wasn't going to work because it's kind of like a national champion type thing, where people will, just like how Holland basically said that the stock price of the VOC is direct to how we are perceived on the national stage. But when it comes to like some semi-cap company in Japan, I think your only risk there is understanding it. But clearly they did the work to understand it. So I don't really know. I haven't read that specific report, but if it is a fraud, then yeah, best of luck to them.
Got it. And so I want to close by asking, so yeah, on your first appearance, almost exactly a year ago, you in our YouTube comments from my subscribers, Blockers, Max subscribers, you did get some negative comments. This is before your portfolio went up 100%. But he said, just another pumper talking his book, looking for extra liquidity. Him saying that long money is underweight technology. I stopped listening right there. Literally everyone is max long tech. If you're long the S&P 500, you're balls deep in tech because the index is cap weighted. I mean, that latter part is true, but that doesn't mean you can't get more cap weighted with tech, which is what happened. Jack, you have the best macro channel on YouTube. Thank you. However, you know that this guest has no substance or anything to teach your audience. On Twitter, I asked people for questions, and someone said, "How does it feel to live rent-free in the heads of so many perma bears?" What do you think?
I mean, as long as I don't have to declare it on my taxes. No, I mean, I honestly I think it's if you have a theory and you get significant pushback from it, that's kind of what, if you can find a place where you can get like quality pushback, right, where people are not just attacking like the general idea of being long technology, but where, you know, if anything, that was part of my thesis, which is just, you know, like the overarching skepticism of tech is going to make it so that this is going to be more impactful on a market level because of the idea that everyone is going to have to rush to buy these things because they are so jaded by, you know, what just blew up in their face during, you know, 2022. So, you know, that is one thing. But the idea that if someone comes up to you and really disagrees with you, but disagrees with specific points of your argument, you know, like I would say to, if anyone like is listening right now and has like a really specific disagreement with something that I've said, you know, please, like that's how you get better. That's how you avoid, like, listen, I would much rather be like embarrassed in public for being wrong on something than be proven wrong in the order book and lose actual P&L, you know? So, you know, it's important not to shut yourself off from people that disagree with you, but at the same time, you know, it has been a little weird getting used to like having a larger following and you're constantly just like barraged with people that just disagree with you solely because you're you or because they're positioned differently, and you know that is less helpful, obviously.
Yes.
But you know, I had a friend who said something, or actually, you can follow him on Twitter. His handle is QF Research. So he said something pretty interesting about. He's always comparing. Which people have done, you know, since this started, to comparing like Cisco in 2000 to
Yes.
Nvidia now, and you know, his contention for the past year, you know, even longer than I've been in it, has been like, this is not the same yet, right? And that like if you want to see a bubble, it can get a lot crazier than this. And I think I said that myself the last time I was on, is that, you know, if it's going to be a bubble, it can get more wild, and I think we've just seen it get more wild over the past 3 months, but. Something that he said was, you know, everybody that doubted AI is now long Nvidia, and that kind of speaks to the like sheer power of a paradigm shift in technology, where you don't have to defend the technology because it's doing the convincing on its own, and you know, so like I said, I am very bullish on AI in general as a technology. The market is going to take it too far, and then it will take it too far in the exact opposite direction. And I am excited for that because I think that presents a really great opportunity to make a lot of money.
So will there be a time, you think, you know, in all likelihood, where you are net short AI as a sector?
If I'm good enough, I mean, it depends if you want to talk about like the time frame of investment. The best story in this specific vein is the story about Druck and Soros back during the dot-com bubble, where, you know, Druck was very bullish on tech and the promise of the internet and bought the whole way up and killed it. And, you know, and then Soros started shorting the dot-com bubble, and for a while that was eating into his returns. So you have these allocators that are, you know, because it's like a model where you allocate to the manager. So you have all this money that's flowing from the allocators into Druck, because Druck is killing it because those stocks are going up. And Soros is just progressively shorting this because he sees that, you know, it's on unstable footing. And then as soon as it starts reversing, you know, Soros starts killing it, Druck's returns start suffering, and the allocators immediately switch to allocate to Druck. But the whole way down, you know, Druck is confident in his thesis, and he's buying the quality names like Amazon and you know, all these companies that are kind of like getting blown out and getting way too pessimistic. So Soros covers his short, kills it. Druck buying the whole way down, kills it over the next 10 years because he's long tech. The only people that lose out are basically the allocators who are running from manager to manager, you know? And I think that the idea of basically when the time comes, I think I'll know whether the risk reward is going to be in going short or in kind of like staying flat and then progressively buying the dip. And that's going to be a function of exactly how distant from reality we get in terms of kind of valuations and stuff. Again, I'm not like a big macro pontificator. Most macro trades that I make have a time frame of like a month or two, maybe even shorter. So I don't know what the economy is going to do, and I think that is clearly a risk. But at the same time, I think that hedging a recession is pretty straightforward right now.
In what way? How do you hedge it for a recession?
I think that you can look at like the SOFR curve, and I think that if we do kind of overshoot to the downside, basically, this is another function of the election, right? So it's going to depend whether it's Trump or, because I mean, you could imagine if we have like a single tick below 2%, Trump will be out there every single day yelling at the Fed to cut rates, right? And or any president will do that, but he'll do it in a way that's a lot more significant. But I think that eventually, if we have real economic weakness, the Fed will cut significantly more than what's priced into the curve right now, and you can buy pretty cheap protection, I think, using SOFR options. And I mean, rates were almost at 5% on 10s, so I wait for that to basically blow out, and then I like just owning bond calls and saying, okay, well, if these calls on TLT get zeroed, all right, my returns will reflect the fact that we haven't entered a recession yet, or or whatever it is, if it's on twos or recently I did TLT. But I think that you can use macro instruments to kind of, that's what they're for, and I try to keep the two things separate and focus on what's affecting these companies and overall sectors. And then if I have to hedge and kind of try my best to insulate myself from a macro outcome that seems kind of opaque to me, then that's what I'm going to do.
So you like being long rates, long the 2-year, secured overnight funding rate. That's futures on that is basically interest rates. So the Federal Reserve will cut as there's recession. Of course, that will not protect if interest rates go up and stocks go down, but you're protecting from that recession risk. What do you think about the hedge value of volatility? By buying puts on the S&P or VIX futures, the implied volatility is quite low now on an absolute basis. It may be relatively expensive relative to the very low level of realized volatility in the S&P 500. I don't know, but the VIX is at 11 or 12, which is not high.
I did the same thing that I did last summer, which probably in whenever I hedge, I don't really like. I would much rather use single leg options than like a spread, because like a vertical spread, it looks really attractive in the beginning, right? Because you say, okay, the S&P is at what the S&P close at on Friday?
54 something.
5,400, yeah. So okay, the S&P is at 5,400. I can buy the 5,200. I can buy the 5,200 put, and I can sell the 5,000 put for the middle of September, and let's say that's at 20, right? And if I put 1% of my book into that, then I'm hedged on, then that'll go up 10x, and that's really neat and clean or whatever. But then what happens is halfway through, maybe you want to monetize that early because you think that the market's bottomed, and now your short leg is, it's a double. But if you had just bought the long leg, you would have been up 500% or whatever. So, but sometimes like especially during the summer, and I did this last year where I just like buy the spread. I put like 1% of the book into it, and I know for a fact that like if things are bad by the expiration date, and if we go down that much, then I'm kind of covered, and I think that makes it a little easier to enjoy my summer. But I think vol is pretty low, so I don't know if I would go with the short leg on that. Yeah, I think that basically I wouldn't be doing this if I didn't think that my stock picks were going to outperform the index. And I have tried to identify tailwinds that make that so. And it's something where you never want to be in a position where you say, oh, God, I could have hedged really cheaply. You hedge when you can, not when you have to. I've taken a pretty significant drag on my portfolio just from hedging, but when I I think probably over the past year I've given up like almost 6% of, or 6.5% of my returns from just hedges, and that doesn't bother me. Like the would I have liked to have that 6%? Sure, but also, would I have made bad decisions if I were unhedged? Because everyone looks at, you have something concrete like your contribution rate from your different positions, and you say, oh, this was a dumb idea. But it's a little more difficult to predict the qualitative aspect of the behavioral aspect, where you say, okay, well, but during, last October, when we were, going down, and that kind of cynicism and skepticism was returning, would I have had the guts to buy the dip there if I didn't already have this pre-existing hedge? And I'll tell myself that the answer is no, because then I can go forward with the idea that I'm protected.
Right. And when you buy a put on the S&P, you're both making a bet on implied volatility, which is probably going to be a negatively absolutely returning vehicle because it's upward sloping. It will trade at a premium relative to realized volatility. You're going to lose most of the time, yada, yada, yada. And as well as just being short, negative delta, the S&P 500. As you said, it only works if you're a better stock picker than the S&P 500, which is very hard. I would say 90, maybe even 95 or 98%, 99% of people, and maybe even 90% of professionals, that's not true for it. I think you may have a good reason to think why, definitely in this environment, you have been picking stocks that are crushing the S&P 500. You hope that continues, and it may continue, it may not, but that is why it works for you. But if someone's like picking stocks in their fun time and then shorting the S&P against that, they're basically making a bet that they're better than the S&P 500, which professionals routinely do not do year in and year out. James, what do you think about when you buy an S&P, $5,200 put, it's at 5,400, the S&P 500 stays at 5,400 or even goes up, or doesn't get close, doesn't decline close to that strike, and every day the days to expiration gets lower and lower? Do you sell and keep on rolling, or do you just let it expire worthless?
No, yeah. I think that in order to get the next leg up, sometimes you have to send puts to put heaven. I'll let it expire and then reassess. But normally when that happens, you can say, well, I guess I didn't have to hedge, right? And if something happens, this happened in April with the kind of like that geopolitical volatility thing, and luckily around that time, my overall allocation was still kind of I think it still would have slightly outperformed even if I hadn't hedged. But there is no easier way to generate alpha than to have your your equity curve goes sideways when the index goes down. It's getting increasingly difficult to generate alpha against the benchmark in like the past month. I think I'm technically underweight Nvidia compared to the S&P. But how much of the S&P does Nvidia make up right now?
Well, because as Nvidia goes up, you keep on selling and rebalancing it a little bit lower, keeping it at a certain weight, whereas S&P doesn't care. It's like if Nvidia gets bigger and bigger as a percentage of the S&P, that's fine. And that's why Apple is and Microsoft are so big.
Yeah, so it gets a little more difficult to outperform the index and keep your risk within the parameters that you want it to be. It's a lot easier to, if you really have like a strong reason to. The most effective hedge that I had all year was I think it was April 4th. Israel had retaliated against Iran. Yeah, Israel retaliated against Iran. They sent some missiles out, and there was a big kind of, this is going to escalate into a regional conflict, and I was not playing that game. I was, okay, like if that's what we're talking about now, then I am going to buy some puts, and that worked out well, because not necessarily because of that reason. And I don't really like the idea of like fading stocks because of geopolitical reasons, because that doesn't work out super well historically. But this worked out pretty well, where I ended up being hedged for that whole kind of episode of inflation acceleration fears, and that is really where a lot of outperformance year to date came from, because that hedge performed really well, and I was able to monetize it pretty effectively on those like big kind of like gap downs that we had. And that makes up for me not necessarily outperforming the benchmark right now, just because so much of the benchmark's returns are driven by Nvidia, and I'm not willing to have Nvidia make up that much of my portfolio right now.
That's pretty incredible that you're now underweight Nvidia relative to the index.
I mean, I'm definitely overweight AI in general relative to the index, but Nvidia specifically, yeah. I don't want to have to increase it, like constantly be trying to keep up with that, because that's that's how you eventually get hurt, and eventually how there will be a drawdown, and there always are. Even if it's going to continue going up, there are periods of time where it underperforms, and that's when you really make costly mistakes. And I would rather be a little underweight now, and then maybe when the drawdown happens, I end up being overweight, than just try to like chase that because some index is outperforming my returns, which it's not, luckily, so far.
James, great to catch up with you. Thanks for coming on, sharing your insights. Where can people find the work that you do on Substack, and where can people find you on Twitter?
Yeah, so the newsletter is citriniresearch.com, and my Twitter is @Citrini7.
There we go. Citrini, thank you. Until next time.
Thanks a lot, Jack.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.